to another episode of ChanTaktic Consulting Group, where we talk about business, motivation, and life. So it's been a little while, it's been a little crazy. Obviously, some of you guys who follow me, I just became a dad. Very happy, very excited about it. I also had the back issues, just got the epidural, L5-S1. Not fun, not fun. But on a better note, here I am giving you guys a little bit of information. I actually got a lot of requests to do a video on investing. You guys haven't really seen an investing video from me for a little while, so just want to share a little bit information here with you, which I think you'll find very interesting. So this is going to be a very, very high overview of one of the investment strategies out there. It's one of my favorite investment strategies, but without further ado, we're going to talk a little bit about Qualified Retirement Plan, or QRPs, and how we can use that in conjunctions with tax deed versus tax liens. So the first time I talk to people about it, a lot of times they say, hey, this is illegal, it's impossible, yada, yada, yada. Not true. So every state out there, okay, every single U.S. state is either a tax lien or a tax deed state. So that's what the first thing we're going to talk about. What's the difference, right? So a tax deed means that you're essentially buying the deed for the property and you're responsible for everything and anything that's liable for the tax deed. A good example of this would be Pennsylvania. So Pennsylvania is a tax deed state. So then you talk about tax lien, which right next door, New Jersey, where I'm from, is a tax lien state. So what that means is it is a superseding lien. So that lien goes beyond anything and everything. So if you purchase the tax lien of that particular property, you are the very first lien. That's what it means to be a superseding lien. So it doesn't matter if there is a bank loan out there on it for, say, $100 grand and you only paid $5 grand for it, you're still the very first lien. So that's how you get your guaranteed return. I know a lot of this is kind of more in-depth information, but I figured I'd share it with you. If you have any questions, feel free to reach out to me. You can always shoot us an email, DM, or just follow our webpage. We actually give a monthly newsletter for free with investing strategies, sales tactics, tactical investment strategies, different things like that. Our website will be in the link below. It's www.ChanTaktic.com. So anyways, regardless, so that's the difference between tax deeds, tax liens. So what are the benefits, right, of doing this type of investment? It's tax deferred, so it's just like your 401k, where it's tax deferred till the age of 62 or whatever the age is for retirement plan. You can lend to yourself just like a 401k. So essentially, it's kind of like a self-directed 401k, and then you can also have a low barrier of entrance. The reason why I say it's a low barrier of entrance is because there's no real restriction on it, and the actual cost of investing in the particular tax lien or tax deeds doesn't really cost that much. So it's whatever the taxes that are owed on that particular property. So then what are the negatives, right? Because everything has a drawback. It's a longer time for return. So generally speaking, it takes about 3 years. It takes you about 3 years of paying the taxes. So you have purchased the tax lien, pay the taxes off for 2 to 3 years, and then foreclose on the particular property. There are certain circumstances where you can do it sooner, specifically with commercial properties. Now that actually goes into the research and the potential liabilities. So whenever you're investing in a tax deed or tax lien, it requires a lot of research. You have to take a look, see, is it worth it? Is there any particular things that you need to worry about? And then the potential liabilities is where if you're a tax deed, you're liable for every single lien that's on the property because yours is not a superseding lien. If you're a tax lien, but you're investing in a commercial property, sometimes commercial properties can potentially come with environmental issues. So those are different liabilities. It requires a lot of research, but very low barrier of entry. And at the same time, it's a guaranteed return. So for the state of New Jersey, it is an 18% return, which is phenomenal. It's awesome because there's not a whole lot out there that guarantees you 18%. With that being said, let me give you a very rough example of what we're talking about. Disclosure first. I am neither a tax accountant, tax advisor, or anything like that. I'm just speaking from personal experience and also from personal education that I've learned from investing. So I'm going to give you a rough example. That was my disclosure. So this rough example shows, let's just say hypothetical, you owe $10,000 in tax, or not you, the investment property owes $10,000 in tax. Specifically in New Jersey, a lot of times during the bidding, they bid up to what they call a premium. So $10,000 in tax, New Jersey's 18% return. So you bid down on the interest rate. So 18, 16, 5, 0, 1,000, 2,000. 2,000 is what's the amount you're paying above. So in this scenario, you would be paying $1,200 upfront for the investment. Now, how does this work? You get an 18% guarantee on the 10,000. 2,000 you actually do not get the 18% return on, but you do get that back if it redeems. What it means by redeeming is if the person actually pays their taxes back and they pay the, whatever penalty is, you get the original 2,000 plus the 10,000 with the 18% on the 10,000. That's for each year. Now, let's just say if they don't pay it, right? So after 3 years of paying this later, and you want to foreclose, you actually lose the 2,000 and you lose the investment that you paid for the taxes. But on the bright side, you own the property. So in this particular situation, let's just say the property is worth $200,000. You paid $30,000, $32,000 because 3 years of $10,000 and a premium of $2,000. For that amount, you own the property absolutely free and clear. So let's just say the property is worth $200,000. You do a quick sale, $150,000. You pay $32,000 for it. So that means you made over $120,000, and that $120,000 is actually tax deferred, which is huge because it's just like your 401k. And if you want to access that money, it's not that you can't, because then you can lend it to yourself and pay yourself interest. Isn't that awesome? Anyways, if you want to learn a little bit more about this other type of real estate investment, or just want to schedule your free consultation for a business life coach, sales coach, or real estate investment strategy coaching, feel free to reach out to us. Hope you have a great day. Thanks, and have a wonderful life. Just remember, your future is greater than your past, as long as you make it that way. Thank you.